Hi everyone, in this video I am going to answer, or at least attempt to answer, questions from my Patreon members on investing, trading strategy, and go over some particular stocks that they want me to take a look at and maybe do some technical analysis. We've got some interesting questions this week. Well, here's a few of them. What investment book should you start with if you're a beginner? Investment psychology, emotional control, how to grow an account, where to enter stocks, daily, weekly process, screening process, options, VCPs, and then looking at some different, and also how do you manage trading if you have a full-time job and you can't watch the market during the day. I'm going to try to answer those questions and go over a few stock symbols. We'll see how far I get. I've got about 30 minutes here. Before we begin, 3 things. 1, if you want me to answer your question, consider becoming a member of my Patreon. It's only $10 a month, and I do technical analysis of my portfolio and focus list every weekend and do answer questions and stuff like that. There's a link for that in the description and comments. And 2, this is not investment advice. This is just my opinion, and I'm just sharing some education and entertainment. And 3, if you haven't already, please check out my partner, Seeking Alpha Premium, what I consider the best crowdsourced platform on the internet for doing fundamental analysis and reading analysis from experts. Link for that also in the description. Now let's go to the first question. Okay, so first question is from Caleb Whitfield. My girlfriend is getting very interested in investing in stocks to start her education, not dictation. I was thinking O'Neill's book, what would you suggest? Okay, so first of all, O'Neill's got a bunch of different books. His most famous one is How to Make Money in Stocks, and that is the one that you should start with O'Neill. But I don't suggest starting with O'Neill because it's pretty dry. His Cancelum system is amazing and has had a big influence on my trading, but it's pretty dry and technical, and you don't want that if you're exposing someone to investing. What you want, now I thought about Livermore, what is his famous book? Reminiscences of a Stock Trader, but that is so, it's more, of an entertaining story for, historical story. There certainly are some gems in there. But don't start with that one either. The one that you should start with is from Peter Lynch, Wall Street, what can we call him? Silverback, I guess. One Up on Wall Street, how to use what you already know to make money in the market. And it's simply that, how the average person can draw upon what they know to do well in the market. And he talks about doing research via going in stores and looking for growing sales and income. It's basic, it's feel good, it gets you excited about investing. So start her with that, and then if she tears into that one and is hungry for more, then you go with O'Neill's first book. And if not, then just point her towards mutual funds. Just point her towards the SPY, the S&P 500. Index fund, and leave it at that. And after you go through the O'Neill books, if she's gets even more passionate, then I'd probably read the Minervini books. I've got a list of books in the description along with little links. I get, if you buy through the link, I get like 20 cents or something. But more importantly, the list of books is there. All right, next question. Okay, here's a hard question from Charville, or is it Charville? Investment psychology and emotional control. And then we'll handle the next one. So let me talk about that first. I made a little note card here. Investment psychology and emotional control. It's tough. It's definitely tough. First is realize you're playing the long game. If you're going to be investing not for days or weeks or months, but years. And it's all one long game. And it really is a game. It's fun. and you have to look at it as something funny. You're not going to want to do all the work. But you can't get frustrated. Well, you can get frustrated, but realize if you have a tough day or week or month, that it's just a small part of the game. And over the decades, you're going to have some amazing years and some years when the market is whipsawing around and you're going to struggle. So think about that. Another thing is you need to approach it like an NFL quarterback does, a successful NFL quarterback, and that is you forget about the play before and you focus on the current play. Now, that doesn't mean that you, when you sell a stock, you forget about it. You absolutely should keep track of it and do post-analysis and so forth. But an NFL quarterback, they throw an interception. They can't dwell on that, right? They have to focus on the next play. And similarly, if you make a trade and it gaps down and you lose 20%, or you realize you FOMO'd into it at the wrong spot and get blasted out with your stop loss, let it go and focus on the next trade. One thing that helps me with psychology and emotional control is, now that I've been doing this for, I think 27 years, is that right? When I'm having a tough month or year, I can look back on those months and years when I did really well and I was using the exact same strategies. So when I think about my winners and the strong trades that I did in the past, that keeps my self-confidence up and reminds me that I'm good at this and I can be successful even if I make a mistake, or even if the market is really tough and I have some failed trades, even if I'm doing all the right things. And then the last thing I would say on that is to get a system, create a system, and I have a system of sorts that you'll learn if you're a Patreon member with me over the next few weeks or months, and follow your rules and be robotic. Figure out the buy point ahead of time, figure out how much you're going to buy ahead of time, buy the stock, set your sell stop, hard stop, or a soft alert, and then let the market do its thing. Be zen, be not nihilistic, be fatalistic. Let whatever's going to happen, happen. And if you get stopped out, you get stopped out. And if it runs up 100%, that's what it does. You've done all you can do is buy at the best possible spot, manage the size of the position, and set your stop and see what happens, right? So, yeah, be robotic. Now, the second half of your question, how to grow a small account. Having a small account is difficult because it's really hard to grow, right? If you have a $500 position and it goes up 50%, you've only made $250. That's barely a tank of gas these days. Two pieces of advice I have for you. One is, and this goes for all size accounts, not just small accounts, is try to ignore the dollar amount in your account and the dollar amount of your losses and successes. Focus on the percentage. Try to get a 3x multiple of your risk. So if your stop is at 5%, you want to gain 15%. And if you're getting your 15% on your trades, then get excited about that and ignore the fact that as a small account, you might have only made $50 or $75 on the trade. If you do the best trades you possibly can and manage your risk and sell at a multiple of your risk, that account is going to grow. The second thing with the small account is, actually, let me tell you one other thing. One thing not to do, don't get tempted by penny stocks and dollar stocks. If you only have $1,000 account, you might be tempted to buy that $1 stock because, you can buy 1,000 shares of that stock versus one share of, Chipotle, or what is up there at $1,000 these days? O'Reilly's, maybe? I can't remember. In any case, but don't do that. The best performing stocks historically have been around $35, and the higher price stocks are safer than the low price stocks. particularly in wild markets like this. So then the last thing I was going to say on that is it's crucial when growing a small account is you got to add to it regularly. Once every 2 weeks, once a month, when you get paid, first thing you do is you transfer some money into your investment account. I don't care how much it is. $1,000, $500, $100, $50, $25, whatever you can. You have to augment your stock gains with money from outside the account. And that's how you get it to grow. Then once it is at a comfortable size, then you can stop adding to it and it becomes self-sufficient, so to speak. Okay, here's another question from Caleb. How do you approach entering into stocks at all-time highs? How do you manage risk? Where do you look to enter, break of high, or wait for pullback, etc.? So this is pretty vague. I think I told you. This is kind of like if someone asks a pilot, how do you fly a plane? It's complicated, right? And you can't just explain it in 30 seconds, but I'll give you a little feedback here. And then I know you're a new member. If you stick with me for a few months, I think you'll get a really good feel of how I do all this stuff. But anyway, so yeah, I usually buy stocks close to all-time highs, sometimes making all-time highs, or in bases that are at least halfway up the base. I do not catch falling knives. I'm not a value investor. I want to buy high and sell higher. And the stocks that historically have done the best are the stocks that are above 92 relative strength when you get into them. It's not buying those beaten down stocks and hoping they come up to their previous highs, because often they don't, or if they do, it takes 5 or 10 years. You know how old I'm going to be in 10 years? Don't ask. So how do I approach it? I look for volatility contraction, and I'll show that on some charts later. I look for the price action to calm down. I look for the volume to calm down. I look for the volatility to get tight. I look for a multi-day pivot point that's a really tight, quiet area. And then when it crosses above that area, that's where I pull the trigger and buy. And maybe I can show some of these later in the video. Where do you look to enter? So break of high or wait for pullback. Now, pullbacks, it really depends on the market. When we're in a strong bull market, like in, say, April 2020, you don't wait for a pullback, because guess what? The pullbacks aren't coming. The stocks break out. They'll go up 3 or 4 days in a row on big volume as institutions jump in, and it'll run up 20 or 25% or more before it pauses to rest. But conversely, in a bear market, the initial breakouts fail most of the time. And they do what Minervini calls pop and squats. And those can be really frustrating. The stock sets up, it breaks out, it pops, you buy it, it squats, reversals, knocks you out of the stock, and then it slides sideways or busts through the bottom of the pattern, or it then continues upward, but you're not on the horse anymore, right? We're in a transitional market right now. I'm really hoping that the market will become an easy dollar environment, possibly after the Fed meeting, June 14th, and in a case later this year. But in a transitional market right now, it seems like about half of the breakouts are failing. So a couple things you could do is you can wait and buy at the end of the day when it looks like the breakout is going to hold up. You can buy a piece the day of the breakout and then wait and see if it confirms the next day, opens higher the next day. Or you can wait for that pullback, and if it doesn't come, then guess what? You just wave goodbye and wait for the next stock. Next question. Okay, this question is from Tony. Have you ever tried using options in combination with canceling breakouts for further risk management, like buying calls on breakouts instead of setting stop loss? That way you know exactly how much you risk if it doesn't pan out in 1 to 2 months, for example. Yeah, so I am not an options guy. I understand the allure. You can make a lot of money with a small amount and you know the amount of risk. But a few reasons why. One, my investing hero and the person that I've modeled my trading after, Mark Minervini, is dead set against options. And so if he's against them, I'm against them. His two main reasons are time decay and the fact that you can't buy options on all stocks. So there are way more eyeballs on the stocks that you can buy options on, and that reduces your alpha. So in the market, there's like 10,000 stocks. Many of them are poorly followed, which leads to price inefficiency and price discovery. But in the options market, there are many fewer stocks available. So these things are more efficiently priced and there's not as much alpha. And then another one, anecdotally, I've heard a lot of guys talk about trading options, but none of them are wealthy. And I do know wealthy people who have become wealthy by investing in stocks and mutual funds. So if you're making money trading options, that's awesome. Keep doing it. I really don't know much about trading options, so I'm not your guy for that. This question is from Brooks. Good afternoon. Thank you for your video. What advice would you have for someone new to technicals who also has a full-time job? I subscribe to MarketSmith and stay in tune to the breakouts near pivot, etc., but always seem to be late to the party. I also find it hard to balance my day between work and research. It seems hard to get ahead. Okay, so yeah, there's no way to sugarcoat it. Working full-time and trying to trade successfully, it's like having another part-time job, maybe even another full-time job. It is a ton of work, and you have to be willing to do the work, or just invest in one or more mutual funds each week. I recommend the SPY, SPY, and focus on other aspects of your life. Otherwise, yeah, working a full-time job and trying to trade individual stocks successfully is difficult, but you can do it. You definitely can do it. Mark Minervini talks about a millionaire friend that he has who only trades after market hours and is a CEO of a successful company and has made millions trading. So you can do it too. You actually have one big advantage, and that is you are not going to be over trading. People, even myself sometimes, the market opens way down or makes some big wiggle and you feel that panic come up and you sell out of stocks, and guess what? 5 minutes later, they're back where they were. So if you are only looking at the market when the market is closed, you're not going to overtrade and trade, ignore your stop and sell early, or cancel your stop and let it fall through your stop and take a bigger loss than you would have. Many traders do better when they trade less. As far as what you can do logistically, so instead of watching the market and buying breakouts when they happen, you're going to have to look at the charts the night before. Make yourself a focus list of stocks that are ready to go at any minute and set an alert. Or set a buy stop, Set a buy stop so that when the stock goes through that price, your buy will trigger, whether you are, the computer will pull the strings. Now, if it's a really illiquid stock, you might want to set a buy stop with a limit so you don't get a really high fill. If it's a big old mega cap like Apple or something, then you can just do a buy stop market order. And similarly, you're going to have to set hard sell stops. My stops are always, well, not always, maximum of 10%, usually between around 5%. And you're going to need to put physical hard stops in with your brokerage so that those trigger automatically if the price falls while you are digging ditches or doing accounting or whatever it is you do. And the other thing that everybody should do, but especially people who can't watch the market regularly, is set alerts on your phone for when stocks are falling down to key areas, when they're going up to key areas. set a bunch of alerts. At any time, I probably have 100 alerts that are waiting to be triggered. And I have them go off on my phone. Gives a little vibration, when the alert goes off. And then I can look and it'll tell me which stock is at what point. And then I can act accordingly, right? And you can do this on your full-time job. Now, you could take it to an extreme and, take a bathroom break and make the trade in the bathroom with your phone. Or maybe you just make a mental note of that and then check the chart when you get home from work and act accordingly. Okay, here's a question from Dal. Hi, Joe. As a new member, it would be great if you can share your daily/weekly process of screening and plan of actions. I'm trying to make the process as efficient as possible, so I'm working full time. Yeah, we don't work harder, work smarter, right? So, a few things here. One, if the quickest way to do this, in my opinion, is to do some sort of relative strength screen where you only grab the top performing stocks. Minervini, I think he recommends stocks with a relative strength of 88 or higher. But if you're really new, you could pinch that off further and just do the stocks with a relative strength of 95 or higher. And that'll give you a list of stocks that are performing really well. And then from there, you can look at their fundamentals and look at the shape of the patterns and so forth on the stock charts and plan entry points. So that would be the simplest way to do it. Now, as far as screens, first of all, I get a lot of ideas from this guy, Mark Minervini, on Minervini Private Access, who runs his screens, and every day he suggests stocks for focus lists. Here's LPG. Let's see. Sorry for the downtime there. Here on Monday, he had a handful of them here. So these they came up when he was screening, and so if I don't have time to use his screens, he's already hand feeding me what he considers the best from the screens. So then I look at those and then I filter them again and put some of these on my focus list and ultimately end up buying about half of them. So that's one thing I do. And then I use MarketSmith. And if you don't know about MarketSmith, it's an amazing fundamental database / screener. It's expensive. It's $1,000 a year, but it gives you all sorts of access. And I run some screens on here as often as I can, at least once a week. And I like to run the Minervini 1 month trend screen, and that'll give us the power plays. And then I run the Minervini 5 month trend screen. That will give us stocks that are firmly in stage 2 uptrends, that are 5 months into stage 2 uptrends. And historically, those are the stocks that have done the best. And then lastly, I like to run this screen, which is my code 33 screen. That is, it will pull up stocks that fundamentally have had 3 consecutive quarters of increasing sales, increasing income, and increasing gross margin. The code 33. And then I go through those and by eye choose the ones that have strong looking charts. I have videos on how to make the code 33 screen and how to find the Minervini trend screens. I will try to remember to put them in the description below. But that's my screening process. And then I have the luxury of being able to watch the market. So every single, let's start in the evening. Every single day after the market closes, I go over all the stocks in my portfolio, all the stocks on my focus list, and if time, all the stocks on my on-deck list. And then I also have alerts set on a bunch of stocks. So even if I don't see them every day, the alerts alert me when they get to certain points. And then, when the market opens, I watch the action, and act accordingly. And then the weekend is also a great time. Get up early in the morning because you got to do the work, right? While everyone else is sleeping in, get up early in the morning and look at your charts and plan your attack. Okay, so Tony wants to look at oil, Oxy and COP in particular, and then Leanne Sullivan is asking about Costco and volatility contraction patterns. Shouldn't they tilt upwards? So let's look at oil. Okay, here is the 10-year chart of Brent crude, which provides the truest picture, the worldwide oil price. Here we see the spike when Russia invaded Ukraine, spiking to 140, and it's been falling off ever since. And where it technically should have gotten support here around 80, it didn't. This sure looks like this is in a downtrend, and oil stocks indirectly move hand in hand with oil prices. So just based on the price of oil, I am not excited about being an oil investor right now. Now, granted, it's a heck of a lot more than it was a couple years ago, and a lot of these companies are really efficient and can make money even when the price is down here at like 35. But it doesn't really matter whether the company's making money or not. It matters whether the price of the stock has become overvalued. Let's look at Oxy. Oh, and by the way, here's the 20-year chart. And as you can see, oil, it doesn't really trend. It really oscillates wildly, and therefore it's cyclical, right? Oil stocks and commodities are cyclical, and so holding these long-term doesn't work as well as holding something like Apple has been for the last 20 years. And here's the Oxy chart. I think this is the one that Buffett was making headlines because Buffett was buying or has bought a big chunk of the company. But I'll tell you in 5 seconds, I don't buy stocks that are moving sideways. You're in no man's land, right? Why you don't want your money tied up in a stock that's moving sideways unless it has a huge dividend, a 5% dividend or something like that. Let's dig a little deeper though. Occidental Petroleum, looking at it at MarketSmith again. It is a money-making company, but look, in 2022, it made $9 a share. Now in 2023, it's only going to make $5 a share. So they're going to make less money. The dividend is only 1.2%, and inflation right now is 5%. The chart is very cyclical. Obviously, if you bought it in 2020, you're golden. But if you bought any stock at its low in March 2020, you're probably looking pretty well. So this is a case of if you didn't do your research, you would hear, oh, Warren Buffett is buying this company. This is going to be the best investment of all time. But in truth, this is really has done nothing since June of 2022. So for almost a year, it slid sideways, so no thanks. And I think, I have not had big success with oil stocks over the years. There are times when they can run 100% in a year, but you really got to get in and get out. And in my opinion, you hold these for weeks or months, not for years. COP, definitely, kind of an ugly chart as well. It's been trending downward since November 2022. Pull it up on MarketSmith here. 2% yield, that's definitely a little better. Same kind of thing. Made $13.50 in 22, only going to make $10 in 2023. So I think the run is over on these things. In my opinion, and I'm not an expert on oil stocks, they made a great run from 2020 to end of 2022, and now they're done until the next cycle. That is my knee-jerk response. The one I think that's performing best is Exxon, right? 3.4% yield. Same kind of thing though. Income is falling off year to year. And if we look at the daily chart, Yeah, it's been sort of trying to make a base here, and it's been getting support on the 200-day. You can make a case for buying off the 200-day, but in my opinion, I'm not in any of this oil stocks right now, so I guess that's my opinion. Okay, Costco, shouldn't VCPs tilt upwards? Okay, so volatility, volatility contraction is one of Minervini's big breakthroughs, and that means that stocks that are going to break up and make a big move to the upside contract. Their volatility contracts. Time and time again, he uses the analogy of a towel, where you got a wet towel and you wring it out. And the first time you wring out a bunch of water. Second time you wring out a medium amount of water. Third time, a small amount of water. And then that thing's almost dry. And the water, metaphorically, is the sellers being squeezed out of that particular stock. When all the weak hands have been squeezed out, then it just takes a little bit of buying to move the stock to the upside. And if a lot of buying happens, then the stock can really run. So let me show you 3 examples of volatility contraction. So here's MasterCard. Now you really got to visualize with me. So here is a large amount of volatility, a medium amount of volatility, a small amount of volatility, and then look what it does. Boom. And then your question was, does it need to tilt upwards? I'm not even exactly sure what you mean by that. But no, it doesn't need to tilt upwards. You just need to see volatility contracting. Let me show you ELF. Here's a great example. Look at this little base in October of 22. Large amount of volatility, medium amount of volatility, small amount of volatility, breakout, and away it goes. Now, I'm just showing you 3 contractions, but a stock can go through many more. It could be 5, 10. The number of contraction is, endless, I guess. But you want to see it get really tight and quiet. You want to see the volume go down with each contraction. Even the SPX right now, if you look at what it's doing right now, we've got a large amount of volatility, a medium amount of volatility, a smaller amount of volatility, then hopefully smaller yet, and then soon, maybe in a few weeks, we will see a breakout as all of the sellers are squeezed out of the S&P 500. Which leads me to Costco. I actually bought a tiny position today, and I marked the volatility here. This is a symmetrical triangle. Symmetrical triangles can break either way, but if you have a prior uptrend, they tend to break to the upside. And here, as you can see, we've got contracting volatility. And look at the trend of the volume is headed down. And I might be a little bit impatient here because we got a little bit of supply right here. But it seems like as a big cap, this one's going to go with the other big caps. And because of the volatility contraction, most of the weak hands have been squeezed out. Well, shoot, I'm over time already, but let me just do a couple more here. Do you ever look to take trades in a range looking for reversion, meaning a stock is at the bottom of a range, you identify, you enter in anticipation for it to head back up? Yeah, I don't like to do that. For example, GM right now appears to be in the lower part of a range dating back to June 22. I probably read that too fast, but what he's saying is it's making this oscillating range. So he's saying since it's down here at the bottom of its range, you could buy, anticipating that it's going to go up. I don't like that in a sideways trend channel because moving sideways is not a sign of strength. And every time it retests this lower support, it's more likely to break that support and fall to new lows. So I really don't like to do that. What I do like to do is buy trend channels that are moving up. Here's a great example of one that I played just a few weeks ago, Super Micro Computer. See how it's oscillating and it's trending upwards. So in this case, the stock is performing well, and you identify this channel, and then when it bounces off, then you can buy and you're near the danger point. So if it undercuts, then you can quickly get out for a small loss. And then when it gets up to the upper trend channel, you can sell the whole thing or take a third off or a half off, rinse and repeat. And these channels will work until they don't. Sometimes they can work literally for years. This one is, what, over a year old now. So this would not be a time to buy. We would want to wait for it to curl back down to the lower line of the trend channel. Now sometimes they'll break out of the channel to the upside and go parabolic. That's really great if you're in the stock, but if you're not in the stock, that's a sign that the stock's run is probably coming to an end, at least for the short term. So that's a stock to avoid. Super quick, ARCT, SCPL, and CODA. This question is from Dahl. ARCT, so it's a biotech, a therapeutic. The biotechs have been doing great this year. Looking at the 10-year chart, it is just maybe starting to stage two. It's got a bunch of supply to deal with. It's pretty far back, but still some of these buyers are still trapped and will be selling as the stock goes up. So that makes me less interested in it than, say, if it was up here at, say, 67 or something like that. We've got, this went from 14 to 28. Okay, so this is technically a power play, just about. You want a move of at least 100%, and then you want tightness of 25% or less. That actually was pretty tight. So you could play this as a power play. I'm actually warming up to this one. We could do something like that. And then probably what you would have wanted to do is start your position at this low cheat and then add to the position right here. In any case, now it's too far gone. If it pulls back and gives some of this back and then makes another gyration to the upside, you could get in. I don't know anything about this one fundamentally, so I can't help you there. SCPL, 𝚙. I've never even heard of this stock. Messy chart, kind of an ugly base here. 16, so it is in the upper half of its base. That's good. You're in a kind of a trend channel here. This is really ugly selling. This was probably earnings. Then you got two big down days. The volume wasn't too terrible. Let's just pull it up on markets. Yeah, that was earnings. Develops digital games. The numbers, it's got good income, good sales. I don't like this price reaction to earnings. So this would go on the old watch list. I would want to wait quite a while and let this abnormal price action get pushed to the left. So I would set an alert at 1750, and when it comes up to 1750, take a look at it and see if it's tightening up, because there's obviously a big seller here at 1750. Now it's tempting. You got a little uptrend channel. It's tempting to buy this channel, but with all this ominous selling, personally, I would not do that. And this is CODA, a 3D sonar solutions for subsea defense mining. Interesting little niche here. Earnings last quarter were bad, but that doesn't mean the stock's not going to do well, because it's all about future guidance. You got a prior uptrend. You got a pretty nice cup with handle. So that looks good. This is the 10-year chart. Double bottom here, and here's your cup with handle. 1-year chart. 1-year chart. So, gosh, it's just really wide and loose. You got a prior uptrend, really choppy on the left side, which is fine, but it stayed choppy on the right side. Volume is, oh man, this thing is really thinly traded. You'd probably need to use limit orders because it's very spready, probably between the bid and the ask. So in hindsight, you could have bought this cheat right here, added to your position right here, and you'd be pretty golden. But it's so spready, it's overbought now. Personally, I'm not I'm not interested in it. It's a low price stock. This would be wild and woolly. I would stay away from it entirely. If you did want to do it, you definitely want to do a small position. Take profits when you get them. If you did want to play this, wait for it to come back. Maybe it's going to come back and retest at like 820 or 830. And then if you saw a bounce to the upside, that would be your time to get in. So yeah, we're at 40 minutes. I'm going to wrap this up. Please like the video if you haven't. Please consider subscribing to my Patreon, or at least checking it out. Check out Seeking Alpha Premium. I do tons of fundamental analysis on that. That's all I have to say. Let me know your comments in the comments below. Take care, everybody.